Good day. For this day, we are going to discuss about accounting for nonprofit organizations. Now, nonprofit organizations basically are organizations that do not have profit as the main objective. So, in other words, it deviates from the primary objective of a business, and that is to have profit or to gain profit. And then for characteristic of a nonprofit organization as an introduction, basically it is non-stock, so meaning it does not issue shares, because we do assume that if a certain corporation, which is the case of nonprofit organization, normally they are corporations. If corporations would issue shares, then such would be assumed to be profit oriented. Therefore, nonprofit organizations are basically or actually non-stock corporations per se. And then let us now discuss formally. I am lifting my discussions from this source. All right. So Advanced Accounting 10th edition by Floyd A. Beams, Robin P. Clement, Joseph H. Anthony, and Suzanne Lowenson. All right. So based on this source, here are our objectives. So we have to learn about the four main categories of nonprofit organizations. Next would be we differentiate between governmental and non-governmental not-for-profit organizations. So we have to know that not-for-profit organizations or non-profit organizations may be government organized, or meaning to say it is actually a state owned or it is owned by the government, or it could be a profit oriented also organization which is of course outside the scope, but then we are focusing with the not-for-profit organizations anyway, and it could also be non-governmental. So basically the not-for-profit organizations are governmental or non-governmental actually. Most especially like schools, of course we have known like schools, colleges, and universities, especially universities are being owned or run by the government, meaning that is a state-owned university, college, or school. And then there are also some colleges that are privately owned. And then in addition to that, for government, it is assumed to be not for profit. But for the private, you have to know if it is really like a foundation, not for profit, or also profit oriented. Nevertheless, our discussions will be centered on the not-for-profit organizations, whether run by the government or not. Then number three is that we have to introduce the FASB principles for not-for-profit organizations. So FASB stands for Financial Accounting Standards Board, which is the board in USA, United States of America. So let us remind ourselves that accounting for not-for-profit organization has no standard specific to it under the current versions of International Financial Reporting Standards. So the more in the Philippines setting that there is no specific accounting standards for this. And that's why also we have to apply the principles for not-for-profit accounting to these organizations, which are also not-for-profit, voluntary health and welfare organizations. Just like, for example, hospitals, which are not-for-profit and non-stock. Also, we have, yeah, I mentioned already hospitals and other healthcare organizations. And number six, colleges and universities mentioned. All right. So here are the categories of not-for-profit organizations or non-profit organizations. So it is being said here like NFP. So it's the same not-for-profit organizations because we understand that in our textbooks in the Philippines, it's NPOs. So I can even say this is NFPOs, right? So non-for-profit or not-for-profit organizations. Here are the characteristics. For the not-for-profit, contributions without expected commensurate returns. So meaning to say when donors, benefactors, grantors would be placing or putting their monies to the not-for-profit organizations, then they do not expect equivalent returns whatsoever. So these are donations being made without expected returns that would be equivalent to the value given with. Then the purpose is other than providing goods or services. It's not like we place the money so that we would get the good or service from the company. And it lacks ownership interest. So we would say that no specific shareholder or owner or partner for the other forms of business organizations, most especially with shareholders, because NPOs or not-for-profit organizations. Again, when we say NPOs, that's what I meant so that I can, of course, go along with my discussions. NPOs are corporations, so we expect that there will be shareholders, but no, then or none. Accounting for not-for-profits, the governmental will follow the GASB, or this is the board for the government accounting standards in the US. In the Philippines, of course, we have our Commission on Audit, though. So if ever it is a state-owned university, so basically it will follow also the guidelines being set by the government in the form of the Commission on Audit. For the non-governmental, especially for the profit-oriented, that will follow, of course, our financial accounting standards in the IFRS or the IFRSs to consider, or in the Philippines, the Philippine Financial Reporting Standards, of course, composed with the accounting standards, the reporting standards, and the interpretations. But then if the non-governmental is not for profit, so in this case, we are going to follow the FASB, the Financial Accounting Standards Board. All right. Then here are the categories of the NFPs or NPOs again. Voluntary health and welfare. So emphasis on the word voluntary. So clearly, this is an organization that would focus on health concerns and the welfare of the members voluntarily. So without necessary payment or commensurate return. Then we have the hospitals and healthcare. So these are now the hospitals that we're talking about for taking in of patients regarding certain illnesses or ailments and other medical conditions. Number three, colleges and universities, which can be state-owned or not, but still not for profit. And the other not-for-profit organizations like churches, museums, especially the social, civic, cultural, religious, then fraternal or sorority form, or any other organization not on these three that would be part of not-for-profit organizations. How do we know? Again, the main line of business is to really pursue, to push, to fulfill or attain or achieve their respective goals and objectives as there in the articles of incorporation, and then the reason why these organizations are organized. So not for profit, but of course, because they are organizations, profits are very important so that in the long run, the company can sustain, or these NPOs can sustain in the long run or long term. Then governmental and non-governmental NFPs. So, well, these are the guidelines, though, talking about the government again. So this is all about the government. Then the non-governmental, we don't have the government as governing it. So that's why we are going to follow the guidelines set by the Financial Accounting Standards Board. Again, we have to take note that there's no specific PFRSS. That's why we are borrowing from the American Institute of Certified Public Accountants guidelines or standards being used in practice. So remember our hierarchy in conceptual framework. So if we don't have these or the specific PFRSS, then we are going to make use the similar PFRSS talking about such transaction. But if not, then we go to the conceptual framework. But anyway, we can also consider the other standards in, for example, other countries which tackled such transactions. So just like this for the profit organizations accounting or the not-for-profit. So we have the ruling from FASB, so we can follow them. Now, here are the accounting principles. So the accounting principles would include the financial statements that we have known. Now, for the financial statements that we have known, like the 6 of them, let us check. There are 6 actually, right, for complete set of financial statements under IAS 1, from statement of financial position, formerly known as balance sheet, down to the 6th financial statement, which is the additional statement of financial position at the earliest comparative period or date when there is a change in accounting policy or a restatement. So whether that is a retrospective application of an accounting policy or a restatement or a reclassification of certain accounting elements or items on the financial statement. So that 6th one could be added, but then normally the emphasis on the 5. So the 5 actually would be, of course, utilized along with or here so that it will be easier for us to discuss. For the statement of financial position, the same. For the statement of comprehensive income and for the statement of changes in equity, then they are going to be combined into one, and we call that statement of activities. However, for hospitals and healthcare, then we change activities into statement of operations and statement of changes in net assets. So meaning for hospitals and healthcare, so they are going to be separated into two. So in other words, for hospitals and healthcare, they are going to prepare financial statements which are very close to the PFRS's complete set of financial statements, except that instead of saying statement of comprehensive income, that's going to be statement of operations. Instead of saying statement of changes in equity, it's going to be statement of changes in net assets. I was about to say changes in net assets because actually it is. Or we have also to take note that net assets actually means the capital or equity or the net worth of a certain organization. However, we just have to take note that for not-for-profit organizations, the term used would be net assets. All right. Then statement of cash flows as being said here. So cash flows are here also the same. And then the notes to financial statements are the same. Statement of functional expenses is only there to support the details in the expenses or operating expenses section under the statement of activities for voluntary health and welfare organizations. So for the expenses, we will know later on as to the functions, but let me just tell in advance that they are into two, the program activities and the support activities. All right, so we'll know such later on or along the way. Net assets, we have 3 categories. So let me begin with number 3, unrestricted, which is available for any purpose. Then for the restricted net assets, meaning they have specific purposes, they can be divided into permanently restricted and temporarily restricted. For temporarily restricted, that's number 2. I'm doing the reverse because it is easier to analyze. The restriction can be lifted if the time has lapsed. So it's a time restriction or we have already fulfilled the stipulation for its use or purpose. So it's either a time restriction or a purpose or use restriction. Once they are there, lapsed or fulfilled, then there would be a transfer of temporarily restricted net assets to unrestricted in the form of journal entries you will realize later on. Next, for number 1, the permanently restricted net assets would be that the asset use is only limited. I would agree to that. And then the implication of this one is that the principal normally for a permanently restricted net asset, for example, or assets, let's say investments being placed in certain money earning or generating vehicles, So what will happen is that they're going to be there, and only the income, for example, could be used on certain conditions or even without conditions. So if with conditions or restrictions, temporarily restricted. If without restrictions, then unrestricted. So permanently restricted will have restrictions on the principal, but for the income, there can be some allowances to be allowed. So the donor imposed stipulations that do not expire or cannot be removed by the entity. Now we have to take note though that the restrictions being placed into the non-for-profit or not-for-profit organizations, or can we just again say NPOs, would be externally imposed. So meaning these are restrictions being set or laid upon by the donors, benefactors, or grantors. So they are the ones imposing the restrictions. Meaning to say, if the restrictions are imposed by the management, so that wouldn't have resulted to any restricted net asset. It would be part of the unrestricted net asset. And that's why you'll be reading on some sources that board designated funds are part of unrestricted net assets because the restrictions are internally made by management. All right. Next, statement of activities again is the combination of statement of comprehensive income and a statement of changes in equity. So that's why we will be seeing the unrestricted net assets, which is basically our profit or loss. And then these restricted net assets are part of the other comprehensive income. So for current, of course, they're going to be showing the amounts. So this would be for the profit or loss section or the income statement, and these two would be for other comprehensive income, formerly known as reserves, for the current versions. And then the revenues and contributions will be in all three areas. Expenses in unrestricted, of course, for operating activities, and reclassifications can happen from the restricted temporarily, to be more specific, because permanent again will normally be not moving except for the income earned as being mentioned or stipulated under the agreement or contract or restriction of the donor, grantor, or benefactor. So going back for temporarily restricted net assets, the movement for reclassification could be the expiration of time or lapsing of time restriction, or the fulfillment or the achievement of purpose or the use restrictions. All right. Expenses can be classified into two. As said a while ago, they can be program or support. For the program, well, these are the activities wherein the main activities or line of business, or of course it's an NPO, so we can say the main line of operations of the nonprofit organization would be based upon. So example, if that is, let's say, a school, so the expenses could be for the salaries of the teachers, for the faculty development, for the student development fund, for the research of the organization, community extension, etc. So these are the expenses needed to be able to accomplish the main objective or goal of the NPO. Support services would be additional activities and expenses. The activities are sources of expenses that would support the programs. Example of that would be the fundraising activities and the expenses associated and the management in general. So of course, you have known this at this level, like for example, the salary of the accountant, or let's say the other managers which are not aligned with the program, so not the program managers, their salaries, incentives, and benefits would form part of the support. So these are the functional expenses classification by which for a voluntary health and welfare organization, we have to prepare statement of functional expenses because that is required anyway. So for the others, it's not required to have that, but we will still be disclosing in the notes to financial statement. So not in the form of a separate financial statement. Then contributions. So contributions can be cash or non-cash. But what is clear is that we will debit the asset and we will credit the specific revenue account. So contribution revenue is treated as unrestricted If we want it to be restricted, so we are going to attach here normally hyphen temporarily restricted or hyphen permanently restricted to differentiate contribution revenue from unrestricted to the other restrictions. Then example also will be conditional promise to give. So we are going to record it as a revenue and a receivable when the conditions are substantially met. So not necessarily that 100% will be achieved, but at least substantially, then substantial is a matter of professional judgment anyway. Unconditional promise to give is that we are going to recognize immediately as revenue and receivable, but then it can be temporarily restricted because of the time. So there is a time restriction. So credit contribution revenue temporarily restricted. So that's how it is for Guerrero's book, but we will see on the sources because there could be some slight differences, but still we can analyze it as it is. Then contributions with donor imposed restrictions. So we have to know what restrictions are there. Are they time or purpose or use as temporarily restricted classification or permanently restricted? And when the restrictions are met for temporarily restricted, so there is reclassification or movement from temporary to unrestricted. While contributions of fixed assets would be temporarily restricted if donor imposed or if board designated. So as what I've said, it will be part of unrestricted net assets. What about transfers or non-contribution? So for exchange transactions or revenues, like sales of products or services, donations with gift of same approximate value. So the exchange is unrestricted because of no externally, imposed, or again, donor imposed or grantor imposed or benefactor imposed restrictions. So these are not externally imposed restrictions. Another one is agency transactions. So for agency transactions, no revenue or contribution, then it would increase or decrease both assets and liabilities. Actually, for an agency transaction, the non-for-profit organization or not-for-profit organization, or again, NPO, is simply holding the money or any asset or resource or economic resource in behalf of another entity or in trust of another entity. So the agency is doing a fiduciary relationship in that it is holding certain resource in trust for the other. So that's why whatever asset is to be received, that is to be debited, but the credit is a liability account. It's possible that there could be income like, let's say, commission or any professional fees that would tantamount to income, but not that amount that was received from any party. Again, the trustor. If that is a trust agreement, well, the agency is the trustee. So trustor is the one giving the trust, trustee is the one receiving the trust. Then gifts in kind, so could be restricted or unrestricted depending on the restrictions again. If you can notice with a lot of examples here, we just have to go to the restrictions that are normally provided in the problem. Question though, how do we know if they're externally imposed? We don't have to worry because such would be stated in the problem. For example, that there is a restriction as to the use or time. So meaning to say, we assume that is an externally imposed restriction by either the donor, grantor, or benefactor. All right. So what could be other accounting issues for the assets contributed? They have to be measured at fair value, including also the pledge receivable. So the unconditional promise to give, or if conditional, then as soon as the restrictions are being lifted. So don't recognize increases and decreases change of or in the net assets or the equity. So it's possible though, because the pledge receivable, of course, initially will be computed at present value, and then the pledge receivables value could change over time, and then the decreases also might have impact on the net assets. I'm kind of doubtful about the don't recognize increases because the pledge receivable may grow along the way because of the interest income. So probably don't recognize like on the pledge itself, but instead that is on the interest income that it is. All right. Then what else? Collections, artwork, historical treasures. So to be recognized at fair value when they are received, and because they have very long lives, so normally they are not depreciated. And besides, their values would really increase over time. So of course, credit to revenues. For fund accounting, we have to consider at least two books, separate books for the funds. We have the unrestricted and the restricted funds. But it is not required for simplicity of recording purposes, though we can do that so that the transactions would not be mixed. And then the fund financial statements will be presented as supplementary information. All right. What about for voluntary health and welfare? So this is how we are going to record the transaction. So just like what we have known from accounting one, to record an expense is to debit the expense. And we can be very specific if that is part of what function and then what specific activity. Well, anyway, this is very specific, but in our accounting one or even in higher accounting, we don't go to that much. Probably we'll just be putting fundraising expenses or costs. And then later on, when we now prepare our financial statements, such would be the time that we are going to classify them properly under the function. So that would not be required. Then special event fundraisers. So anyway, another thing also to take note is that since those are the things that we have known from basic accounting, it doesn't mean that they cannot be changed. So remember under IAS 1, an entity is allowed to add more account titles or to include account titles that the entity believes such would result to more relevant and faithfully represented information. So those are the two primary qualitative characteristics, relevance and faithful representation. So it's okay if we use these account titles, just like for the second one, unrestricted gains, special event, that's okay. And then for the final one, pay fundraising cost of special event, $250, then we are going to apply that to the gain and to credit cash. Okay, so that's how it is done because probably this is for the special event fund raisers. Anyway, these are specific things and accounting procedures done for a voluntary health and welfare organization. Then special events are not revenue. They are not on the main line of operations of the business, so they are treated as gains. Next, what about for cash donations and pledges? And the pledges have no purpose restriction, so both are under unrestricted. Actually, cash is unrestricted. $1,800 of $6,000 pledges are to be collected next year. However, because of this part here, initially that was unrestricted, it becomes restricted, temporarily restricted to be more specific because of the time restriction. Support, contributions, restricted or not, is revenue. Then revenue accounts are actually, for a while, I'm going to minimize. I cannot see the content. So support, contributions, restricted or not, is revenue. Okay, so that's true though. But remember, contributions will have to be classified properly because if they are not restricted, they will form part of the income statement or profit or loss computations. But if restricted, they have to be part of the OCI section. So here are the revenue accounts are close to net assets. Oh, by the way, for the OCI section, well, other comprehensive income section, for the changes of them, of course, current, but for the cumulative on the statement of changes in net assets for a voluntary health and welfare. But then again, if this is just any other not-for-profit organization, so they have to be mixed into statement of activities. Then revenue accounts are close to net assets, whether whatever classification that is. If we go back here, that's cash contributions receivable at 6,000. So there is, where are these coming from? So they're perhaps being assumed like 600 allowance for uncollectibles, then unrestricted support, that's 7.6, and temporarily restricted, the 1.8. That's the amount. So how do we compute though? All right, so if you can notice, cash here is assumed to be at 4,000. It is not stated anyway. Then contributions receivable is at 6,000 total. 1.8 is to be collected next year, so that's under temporarily restricted. That's 1.8. The support here that is said is contributions receivable. The contributions receivable, of course, debit will be the total, but the revenue will have to be dissected or will have to be separated from each other. The allowance is at 10%. 10% of 6,000 is 600. And then temporarily restricted here. So the balance is 1 here. This is the 1. So that's 10,000 total minus 600 minus 1.8. That's 7,600. All right. What about if we collect a time restricted pledge? So then we have to close the receivables to debit the cash. Then there would be a reclassification. So movement from the temporarily restricted net asset at reclassification out or dash 1,800 to the unrestricted net assets reclassification in 1,800. For other books like Guerrero, the debit would be net assets released from time restrictions because the restriction is time. So net assets released from time restriction, and the credit would be unrestricted net assets. So at 1,800. Regardless, they have the same meanings. All right, so reclassification accounts would happen again for temporarily restricted net asset items or net assets items. Next to that would be, let's have this bigger. So receive equipment and use it. There is a use restriction in the sense that it gets used up. So there is a use restriction for that. Then, of course, the equipment will have to be depreciated over its useful life. Then there has to be a movement from temporarily restricted to unrestricted as the equipment has been used along the way or along the years. So this is a good point though, because the equipment is temporarily restricted. But if it is not, it is unrestricted. Again, no need for the third entry or item. Next is to receive cash with purpose restriction. So that is why we have temporarily restricted credited. If there are expenses, then we are going to make an entry. And for that, we have to make a reclassification from temporarily restricted to unrestricted because how did we use the money here, 900 pesos, for the research purposes or expenses or costs? So meaning to say, we released 900 from this amount and then we pay that later on. So supposedly it's like this first, this second, and the third. Supposedly, if we are going to logically arrange the said entries. And then, good point here, if cash was for buying equipment, reclassify as it is depreciated. Okay, that's good, just like with the illustration a while ago here. Then what about donated services? For the donated services, then we are going to, of course, record transactions at fair value. So the case here is that services are supposedly to be paid by the NPO, but then instead of paying, it was given as a donation or sort of donation. So that's why we'll just debit the expense account as it is, whatever that specialized service or services is or are. Then we are going to credit our contributions revenue or unrestricted contributions because this is a revenue. So debit the expense, credit the revenue. And then for Services of general labor, non-specialized, that result in non-financial assets, record the asset and the revenue. Okay, so again, for specialized services, expense and revenue, for the second one, then debit the asset and credit the revenue. Take note, this is general labor, so construction in process, probably, for example, let's say for a construction of a certain asset. So that's why it is debited to CIP. Because remember, if that is other service, which is, I mean, non-specialized, but then it is not actually general labor. So, well, that could be just also a debit to expense and revenue. But for this one, services of other general labor, door-to-door collections, not recorded because I suppose this is the case we're in. The labor has been paid immediately. So no recording of revenue. Instead, expense and the asset payment of cash. All right. So, or any other asset used as payment. Now, this is the first part of our discussion. So hopefully you learned something. Then stay tuned for the next part of our discussions. Thank you very much and God bless.